All right. So everyone in the class, very good morning. Very good morning. Welcome to this session. Please tell me, can you all clearly see me, hear me? What is the status first of all? Am I very clearly audible to you all? All the live people, very good morning. Welcome to the session, recorded people. Very good morning. How are you all? So, who all do we have in the live class today? Please say something in the chat box. Good morning, people. Yes, people in the chat box, good morning, good morning, good morning. Harshita is there. Then the next person, what's your name? Shruti is there, good morning. Jashwant is there, good morning. So let me also check. Is my audio video proper? Please tell me the first thing. Then we will start to talk. Just a minute. All this seems perfect. Great. So great. This being the very first lecture of our very amazing, designed for the very first time, an exam focused regular batch for the subject of AFM for the attempt of May 26 or September 26 and onwards. Perfect. So in this batch, you are going to learn AFM with real depth. You are going to understand it right from the basics, right? You don't have to think, sir, we have now come to final. You just have to think that you have only passed intermediate. Rest is my responsibility to make sure that whatever you have learnt at intermediate level, I have to pick it up right from there, make you people understand the concept right from that level, and then take you to the final level and then make you ready for the exam level. That is how the approach in this class is going to be. Perfect. So before that, Kanika is also there. Kanika, very good morning. So all the live people, very good morning again. Yes, please tell me, is this the first class you are doing, or you have done any other subjects before this? This is something I'll have to first of all tell me. So tell me two, three things. One, this is your which subject? In the chat box, come on everyone. This is your which subject? As in first subject for which you are doing the class, second, third, whatever. Second, when are you planning, like when is your attempt? And third, which city are you from? Come on. This very quick thing, let us do. Yes? Please. And also give me a second in the meantime. Just a second. Yeah. So, Fintech Stent. Oh my god, what's your good name? Fintech Stent. I can see your Google ID, but not your name. Yes. So, when do you people have your attempts? Shruti, first time attending AFM class. Cool. Shruti, have you done any other subjects class so far, or this is your first experience for a CA final class? Then you're from Belagavi, Karnataka, giving your attempt in May 26. Okay, Shruti, cool. Nagendra Babu, yes, tell me, when is your attempt and everything? Yes, people. So let me first of all introduce you people to the subject and show you the study material, make you people understand. So give me a minute. Let me in fact first of all download the study material. So I'll show you both the study materials. The one that we are going to use in the class, for which you must have received the hard copy, and the second study material is the institute's study material, so that you have the confidence of whatever we do in the class is a compilation of institute's study material. It is a better organized material, then the institute's material, and it covers everything in the institute's material, right? So let me first of all show you the material that we are going to use. Let me first of all share my notes, share my screen. So we have September 26th, Nagendra Babu, as your attempt. Okay. After your exam oriented Hindi batch. So Jashwant, it's your second subject. June, you are doing CMA, Andhra Pradesh. Fine. Kaneka, third subject from Tamil Nadu. Attempt May 26. All right. So people in the class, if May 26 is your attempt, then please make sure that simultaneously, listen to it. A lot of people have chosen this class for the May 26 attempt. We are start of the Jan. The batch is going to take around 180 hours, right? If we divide it by 3, so 180 divided by 3 means we need 60 lectures. Means the batch is going to go, if we do it every day, generally it is 6 days a week, but if we do it every day, for example, divide by 6, give me around 10 weeks, means 2.5 months at least. Yes, subject to any kind of uncertainty. So the point is that you should, along with your classes, continue to study. Yes, other subjects, continue to revise and practice this particular subject, so that along with classes you have your first revision in the during this phase of classes itself. Perfect. So anyways, that detailed guidance I will give to you, but before that let me share my screen. Yes, so one more thing before I share my screen. Yes, so let's make sure that lecture 1 is really light. Let's spend some time to know each other. Let's spend some time to know the subjects and get that comfort, and then over the time we'll speed up. My first question, and very important question to every single student sitting here. Do you people have any target in mind for the subject of AFM or for the entire subject of CA final? Do you people have any target? So let's talk about AFM. Do you think it's really possible to score 60 in AFM, or is it possible to score 70 or 80 plus in AFM? Or it's even possible to score 90 plus in AFM? What do you all say? Everyone in the class. People. Do you have any target in mind? So all the students who are watching this lecture but are not to the live point, they are lagging behind, kindly come to the latest live point. Yes, 80 plus in AFM. So is it really possible to score 80 plus? It is very well possible. It is 100% possible. The way, the approach, the quality, the comprehensiveness with which we are going to learn in the class, 80 plus score is really doable for you people. It takes the efforts from both the sides, from my side as well as for your side. In the class, you will see that the efforts from my side is beyond your expectation. But if you also make similar effort, then the score of 80 plus is 100% doable, and it is going to help you to clear your entire group or maybe entire exam of both the groups. Perfect. So I would highly appreciate that the first step to do great is to first of all dream, or first of all set a target, because otherwise randomly, without any target in mind, in a casual manner, if you end up studying, then you may pass. You may score 60, you may score 80, but not necessarily that you will score 80. You may just end up passing because you don't have a mindset of what do you want to achieve. If it is there right now, remember it, till the last day of your exam, you have all the facilities available from my side for you. Let me tell you one by them, starting with the unique handmade notes that you will see. Handmade as in, I will tell you what do I mean by handmade notes. So the first book that you're going to receive is this Outnotes. These are very uniquely designed. Means only the students who have taken this batch or my batches would be able to have the hard copy of these notes. Yes, they are uniquely designed, means nowhere else you will find such notes where everything is presented in terms of tables, timelines, structures, charts For example, some of you must have already seen it. For those who have not seen these notes, let me show that to you, right? So just give me a second, just give me a second. Let me show these notes to you. Perfect. So as you see here, the notes are all colorful and they are all in terms of tables, timelines, structures. Because we strongly believe, for example, let me show you a particular chart. For example, this particular chart. There is something called as correlation. We will learn about it in the portfolio management. The value of correlation can be positive one or it can be negative one. Teaching to you all, please pay attention, teaching to you all this particular thing in terms of text, people, will not have as impact in your brain as it will have if I teach that to you using colorful diagrams, charts. This is just one example. Let me show you more things. For example, this particular thing. These formulas that we see, how is the total broken down into two parts? So the presentation of that in colorful format, or maybe for example, if we have to understand this particular chart. Yes. So when you create the chart at your own, when you decide at your own the x-axis, the y-axis, the equation when you create at your own, you are able to always remember it. So point is that all the people in the class, point is that these notes are really unique where we have the text least in the least possible manner, right? And all your learnings will be primarily in the form of tables, timelines, charts, conclusions, everything which make your learning effective. So what will happen? For the very first time, you understand the thing really well. Because for example, when we create, let's take the next example. When we create this particular chart, for the first time, when we create it together, your learning become better, your learning become easier. Second important benefit, you learn it today, you'll be able to retain it for a longer period of time because your brain is able to remember images in a better way than the text. Yes, you can recollect watching any movie that you have watched maybe 10 years back. Now you would be able to recollect that particular movie. Yes, that's the power of picturization that your brain has. So that is what we are trying to use. If you are, for example, you see this chart, once you have seen it, even if I right now tell you to forget it, you won't be able to forget it. That is the power. That's how powerful your brain is. Perfect. So we make use of this power. You are able to retain the things for a longer period. And third most important benefit, the book that we prepare together in the class become a Bible for you. Bible for you meaning to say everything that you write down today in the class will be the single source of multiple revision, that 1.5 day revision till the exam, right? That become a single source. It has compilation of everything, meaning to say every note. For example, I want to make you people understand this concept, as well as I want to make you people give the steps to solve practical question, as well as I want to make you people know a particular note. Everything that you need to know for the exam is there in this book. And when things are presented in this manner, for example, this particular equation, this particular chart, this particular conclusion, and these steps, when things are presented like this, your revision become quicker because you don't have to spend time to read the lines. You have to spend time to see the things rather than reading them, making it really fast for you. Perfect. So these are, first of all, your out notes. And let me tell you one particular thing. Every single word, every single diagram, every single heading, color, boxes, drawing, everything that you see here has been done by me individually, personally, without any external help, without getting it done from someone. So along with using it in the class, I have a personal attachment as well to these notes, because literally every line, every word is not a copy paste. I have typed down my thoughts here in this book. Perfect. So what we study in the class and what's being written here will be almost aligned, because at both the places it is my thought process which has got implemented. The second book you will receive are these out scanner. Let me show you the front page. This is the out scanner you will receive. There is a possibility that the book cover may change for you, but the book that you are going to receive is going to be this one only. There is a possibility that the book you may get will be for your particular attempt. For example, right now it is 3rd of January 2026. You're buying this class, for example, for Jan 27 attempt, which is very well applicable, right? It's applicable till the next 2 years at least. At least I'm saying. It can also be even for 2.5 years. So from 1st Jan 26, it will go to 27, 28, mid 28 it is applicable. Perfect. So the book, the outscanner you receive that may be possible is for your attempt, which is why the sequence of question may be 1 or 2 question here or there, which you will have to consider. The next point, let me show you the book, right? 1 second. So this is the book that we refer to. The best part of this book, it has a compilation of all the relevant questions from the exam paper, right from the year 2002, which means of over 22 years, over 23 years, which means at least 50 attempts it has a question from. It has questions from all past RTPs, all past MTPs, study material, practice manual or any other publication of ICI. It has everything, meaning to say, beyond this book, you will not be needed to cover even a single question released by the institute which is relevant for you. Everything relevant has been included here. Perfect. Second important thing, sir, every question, if you observe, has a QR code. Again, this is really unique, only you will have. Sir, point is, suppose you have done this question today. After a year, you're not able to recollect a particular point in this question or maybe the overall zoner of that question. In that case, you can scan this QR code, right? Scan the QR code and you'll be able to watch the video solution of this particular question whenever you want and as many times as you want. Perfect. So this is how the QR code will work. Sir, how will you receive all these details? So there will be 2 emails. One from the official ID of FAST that you'll be able to figure out, which will have the serial keys and everything. I'll confirm the email ID tomorrow. You will receive another email, right, for the credentials and the link of the application through which you'll be able to download the application and scan this QR code. The details I will share tomorrow of the email and everything, but there are going to be 1 or 2 emails you will receive. Perfect. Which means this is the question bank which we will refer to. Next thing, as I said, today you will have to be a bit patient because before starting the class, you should have the confidence of what all are you going to have, right? Learning, we might delay for half an hour, which is fine, but the next 180 hours that we spend together, you should have a sense of what we're going to do. Third thing, sir, we have taken a class today. Yes, your attempt is maybe after 6 months, after 1 year, 2 year, 2.5 years, whatever. Sir, during this phase, if there is any new concept for which there is a rare chance, for AFM, addition of concept is a rare chance. But still, if there is a new concept, or sir, during this phase in the RTPs, MTPs exam paper, if there are new questions, how are we going to cover it should be our next question. Yes. Are you people understanding what is going on? Have you people received these books when you're watching the lecture? Have you received the outnotes and outscanner? People, come on, tell me. So Vijay in the class is your power batch student. You couldn't attend the live back then, guys. Make sure you participate well and answer in the comments whenever you ask a question. It will help you retain the concepts. Yes, very well said. So Vijay says, if you are here in the class, do participate. That is what I will come to, because when you participate, you are actually not just answering to me a question. You are revising in your brain that particular concept, that particular point before you answer to me. So my questions actually help you to do the revision, and when you revise it today, you are able to retain it for a longer period of time. So you have received, some people have received the book, some are yet to receive it. Perfect. So I was talking about the new question. For every attempt, we come up with this file called as new question by ICI. For example, for the attempt of Jan 26. This is the file we have come up with. What does it have? This particular file has compilation of only new questions of asked by the institute in its RTPs, MTP's exam papers of last 5 attempts, right? Or maybe we will make it 6 attempts. So it will have a compilation of all the questions asked by the institute in the last 2 years. Perfect. Along with the notes that you've received along in this batch, right? If you refer to this particular PDF, you are all set, all ready for your exam, because this PDF has a compilation of new questions and the older questions are anyways there with you. So whenever your attempt is, look for this PDF for this attempt. It will be there on the Telegram channel. So one more very important thing, in the description of this video, you have the link to the Telegram channel. Must join that channel so that if there is any update regarding this batch, regarding any PDF, regarding any video or anything, all that is accessible on that Telegram channel. So must join. Any information, any update, any amendment, all that happen on the Telegram channel. Perfect. So the compilation, you will find it here, which is all set already. Not just the PDF you will also get a video solution for these new questions, right, on the YouTube for every attempt. That is also done. Sir, then today you have taken the class. After 1 year, 6 months, 2 years, whenever your attempt is, it may happen that you're not able to recollect the concepts that we have done today. It may happen. Although the outnotes are really brilliant, so it's difficult that you'll find it difficult to recollect. It's really difficult. Perfect. For example, when you learn it, anything in the manner of charts, diagrams, it's really difficult that you're not able to recollect. However, if it happens, on the YouTube is a playlist. I'll give the link to the playlist again in the description. The playlist has individual chapter wise revision, very detailed revision of concept, as well as one question of every concept, so that you have a comfort of understanding the concept, revising the concept, as well as applying it to the practical question. Perfect. This was about the revision video. Sir, what about the theory and MCQ? The outnotes that you have received, at the end of the outnotes, you have the compilation of theory notes. That is all sufficient, more than sufficient for you to refer to. Let me also show you the theory notes. Theory notes which are primarily based on institute's study material only, because unless you write down their headings, their keywords, you don't get marks. So these are the theory notes, right, which actually has the compilation of all the concepts, right? I will guide you over the time what are the main theory chapters, how do you write in the exam, how does the institute ask you question, everything will guide you over the time. Just that we have presented the institute's answer in a better manner, in a pointer format, so that it become easy for you to and interesting for you to learn. Sir, what about MCQs? Two possibilities. Either MCQs will be there towards the end of the outscanner, and second possibility is that you will have a separate book of MCQ other than outscanner. These are the two possibilities, which means whether it is theory, MCQ, concept, question, anything, you have all the materials ready with you. You don't have to refer to anything else, is what I'm saying. Perfect. I will now show you the study material. I'll now show you the study material. The institute's official study material. I have not downloaded right now 2020. One second. I have not downloaded right now 2025's material. 26 material, sorry, applicable for May 26 and onwards. But that's not a problem because chapters more or less will remain the same. Let me find. So according to institute, you have chapters named as financial policy, corporate strategy, risk management, advanced capital budgeting. Perfect. So you have a total of 15 chapters to cover. These 15 chapters have around 4 chapters or you can say around 5 chapters which are primarily theory, which has no practical question, or maybe just one concept of the practical question, two concept of the practical question. Perfect. Rest of the 10 chapters are primarily practical questions. Yes, chapters. Sir, what are the example of practical question chapters? Let me show you. So again, for your ease, for your comfort, I have done this. As you see, there are total of 15 chapters according to ICI study material. But we have, changed a sequence. We have changed the bit sequence of those chapters to make your learning easy. For example, if you look at chapter number 5 from the Institute's study material, you observe this. Chapter number 5. Where is that? Here it is. Security valuation chapter, which covers the valuation of equity share, preference share, debentures, or money market instruments as well. Right? So what we have done is in the security valuation chapter, equity valuation is a different category, requires a different thought process. The other 3 chapters like preference share valuation, bond valuation, money market valuation, they require a different thought process. So these 3 chapters are combined to form a new chapter in our outnotes. These 3 sections are combined to make fixed income security in our outnotes. Similarly, the equity valuation part of security valuation has been merged with the next altogether new chapter, chapter number 13, to make it equity business valuation chapter. But sir, why would you do so? For your ease, for your comfort, because the thought process required for these 2 chapters is exactly same, and it is required for fixed income security is exactly same. But between the two, the thought process is entirely different, not comparable, which is why we have done it. So which is why the chapters that you will see in our book are like this. Yes, it may happen that the institute's chapter when you see is this, but this is for your comfort that everything which is there in the institute's material, all 15 chapters are covered and covered in this manner. So for us, the index of practical topics become this. First chapter we do is equity business valuation, then a chapter called as M&A, then fixed income security, then portfolio, then mutual fund derivative, forex, advanced capital budgeting, risk management, and so on. Yes, but before that we are going to learn the basics of AFM, which is what will connect you your intermediate. It will bridge the gap as between what you have learned at intermediate and what you need to get started at final level. That bridging chapter basics is really important that we will focus on. Perfect. So everyone, are you people all clear, all sorted with what we will do in this class? All clear with the notes that you will have to refer to? Everything, are you people sorted? Anything that you people want to particularly ask, please tell me. Come on. Please tell me. Anything that you want to particularly ask. If no, we get started. Yes, people. So while you people are responding, can I share an expectation that I have with you? Oh my God, sir. Just a second. Yes. So can I share an expectation with you? A really important. You people might think that, oh my God, sir, we already are failing to meet the expectation of our girlfriends and boyfriends. How are we going to take the responsibility of one more expectation that you have now? I'm expecting only these 3 hours of yours every day, sincerely, and more importantly, attentively. Meaning to say, along with me, if you learn to think in the class, along with me, if you think, then please, people in the class, mark my words, your thought process will evolve. You will develop within yourself an ability to think, which will be of help to you in AFM, in the entire CA final throughout your life if you develop that ability to think. And that is my responsibility to make sure that I develop it for you. All I need is your participation. When I teach, you will have to actively involve in it. That's what I'm expecting. That's all I'm expecting. Perfect. So the approach for the class is going to be really clear. We are going to learn a concept right from the scratch. Perfect. Learning it from the scratch, then we will take it to the exam level, that concept. Then we will also understand that how do we apply this particular concept to any question. When we solve the practical question, we will try to again link that practical question to the concept we have learned, fit that question to the concept that we have learned, and then solve the practical question. So this cycle is a complete package where you understand, apply, remember, retain, everything is there with you. All you need to do is to participate. The more you answer my question, the more interesting the class become, the more interesting the lecture become for you people, and the more, for in a better manner you will be able to learn. Perfect. So now very quickly explaining to you the exam pattern, right? And then we will start with the very first chapter, basics of AFM. Yes, people. So let's everyone get started. Those who are watching up this lecture and you have, if not yet liked the video, then please do like the video, because it is going to give you great learning. The batch is going to give you that great learning, that I can assure you. Yes. So everyone, let's get started for our target of 80 plus in AFM. Let's get started. Yes, perfect. Harshita, MCQ book as of now, I will update that to you. Either that will be a part of MCQ, that will be the part of the outscanner. Towards the end of the outscanner, you will have the MCQ, or you might receive a separate book. Any of these things may happen to you. Perfect. So your 100 marks paper. Your 100 marks paper will be broken down into two parts. 30 part MCQ, 70 mark descriptive. 70 marks will be descriptive. Sir, how will we get these 70 marks? So there will be basically people in the class, 5 questions of 14 marks each. 5 questions of 14 marks each. Meaning to say, you will have 1 question compulsory and you will get 5 questions otherwise, right? So question number 1 will be compulsory, and then will be total of 5 more question otherwise. Perfect. So you will have to do 1 compulsory question of 14 marks. From the rest of the 5 questions, you will have to do 4 questions of your choice. 1 question you can skip. So there will be total of 5 questions of 14 marks each that you will have to do, with first being compulsory, getting you 70 marks, and 30 marks will be MCQ. That's how your paper will be of 100 marks. Perfect. Which means in total the paper that you will see in the exam will be of 114 marks. 100 you will appear, and 1 question of 14 marks here extra that you will have. So sir, MCQs are asked only in this particular section? The answer is yes. Sir, what about the descriptive in the theory in the descriptive? So in this question, in this portion of 70 marks, where there will be the total of 6 questions, out of which you will have to do 5, right? Generally, there are 2 possibilities. You will get first question of 6 marks, second question of 4 marks, third question of 4 marks, possibility 1. Or second possibility, first question of 8 marks, second question of 6 marks. If it is 8 marks and 6 marks, making a total of 14, they are generally practical only, right? If this is this particular combination, then it will be practical, this will be practical question, and last question of 4 mark, right? Within, like every question is broken down into parts A, B, C. So this particular part C will be around 4 marks, which will be a theory part. So that is how institute also test theory. Which means there is a possibility that these 5 questions of 14 marks in total that you do, it may happen that all 5 of them are in this format having a theory, or maybe 1 or 2 of them is in this format having no theory. only practical. Any of this situation is possible. We can expect but at least 3 to 4 theory questions in the entire paper. Out of 6 questions there, 3 to 4 at least theory questions will be there. From which all theory chapter that I will guide you over the time, right? I have given to you that also. The theory chapters that you're gonna refer, are primarily startup finance securitization, then financial policy, corporate strategy, and risk management. Primarily these 4 chapters. If the time allows, then you also do security analysis. But as you can see, observe in the past, right? I mean, the further updated chart I will show you on the screen anytime during the lecture. But you'll observe that primarily the theory question come from these particular chapters. It is a rare scenario where theory is being asked from the other chapters, as you can see here. Perfect. So this is what it, people in the class, is. Now let's get started with the discussion, right? So everyone, let's start our discussion with the basics of AFM. This basics will have different formulas, different basic concepts that you are going to use across AFM in all the chapters. It somewhere relates to what you have already done in AFM, what you have already done at CA intermediate level. But let's try to revisit and make sure our learnings are really concrete and sorted. Perfect. So how are the energies to get started with this, people? Come on. Are we all energetic enough to get started? What do you all say? Raise your hands. Come on, tell me. Shall we? Proceed. Come on, people in the class, shall we proceed? Are we all ready? Yes, all ready? So let's get started. I really wish you have an amazing experience. You have a great learning experience with this batch. So people, let's get started talking about the income statement first of all. Sir, although the income statement relates to the subject of financial reporting, but it is using the financial statements we will do a lot of calculations in finance, right? So broadly, the format of income statement you should be able to remember, because based on the income statement, there may be sometimes some indirect question which you will have to solve. So starting with the first number of income statement, which is revenue, right? Revenue is the first number that you have. From the revenue, if you deduct the cost of manufacturing the goods, what do you call it? Come on. This should be really interesting for you, because you have come from intermediate where all these things have already been taught to you. So let's try to recollect how much. Let's try to figure out how much are we able to recollect. Everyone. Shruti, Jashwant, Nagendra, Harshita, come on. Others in the class, what do you guess? What is the first cost? All the recorded people in the class, please participate and tell me what is the first cost that you deduct from the revenue. Sir, it is the manufacturing cost of goods being sold, called as COGS. So COGS, when I deduct, the profit number that I get is called as gross profit. Cool, easy. The next number that I get is gross profit. Fine, sir. Fine. Next is deducting 2 further costs. One is admin and general. Next is selling and distribution. Selling, marketing, distribution, whatever you can call it. These are other 2 costs related to the operations of the business that I need to deduct from GP, gross profit. When I deduct these 2 costs, I get my next level of profit. Right? Sir, let's imagine that depreciation has not been included in these costs. For example, a machine was being used to manufacture a product. Cool, it relates to manufacturing. Yes, it should actually be a part, that depreciation should actually be a part of COGS. But let's suppose that cost has not been included in COGS. Then the profit so arrived is called as EBITDA. EBITDA. Do you people know what EBITDA is? Earnings before interest, tax, depreciation, and amortization. This is what EBITDA is. Don't worry about writing down the full form of this particular word because you will automatically become so habitual of it that you will end up remembering it automatically. Perfect. So what we get is EBITDA. Sir, since depreciation has not been included in these three costs, right? These are the costs excluding depreciation, which is why we are saying earnings before interest tax is fine, but earnings before even depreciation and amortization, meaning to say they have not been deducted from the cost so far. That's how EBITDA is. Sir, do we also have to write it, sir, along with you? The obvious answer is yes. Along with me, you end up writing at any point if you feel that, sir, give us few minutes for writing, you let me know in the chat box, we will do it. Perfect, fine. Sir, after EBITDA, the next item we deduct is called as depreciation and amortization. Perfect. Depreciation and amortization, if you deduct, the profit so arrived is called as EBIT. Earnings before interest and tax. When you borrow from someone, you take debt. On that debt, you have to pay the interest. So that is the interest. And after paying interest, the profit which I'm left with, I have to pay a tax on it. So that tax is also an expense. So before these two expenses, this is the profit I have. So let me also deduct first of all interest from it. The profit so arrived is now profit before tax, or you can sometime call it earning before tax, one and the same thing. Perfect. Fine, sir. From profit before tax, if you deduct the amount of tax, the profit so arrived is called as profit after tax or earnings after tax, or sometimes we call it net profit. Or we can simply call it net profit. This is the final profit that we generally talk about. If I ask you what is the profit of my company, this is the profit what we primarily talk about. Can you all people tell me, everyone in the class, can you all please tell me, live people, recorded people, please answer this question. On this particular profit, who all have a right? Who all have a claim over this particular profit that you see here? Come on. Try to think and tell me. I'll start the day with some easy topic and with some easy question. Over the time we will upgrade. I'll ask you the more advanced question, which I'm sure you are going to like it. You know, in this entire story, we have missed one thing. My particular introduction. My particular introduction you have missed. Are you people really interested to know that or not now? What do y'all say? Sir, this particular profit belongs to the shareholder of the company, which includes both the shareholders, equity shareholder as well as the preference shareholder. And between the two, who has a priority, who has a preference of profit distribution? Sir, it is the preference shareholder who has the priority. So if you deduct the dividend, the preference dividend from this profit, then we can say now whatever is the earnings left with the company will belong to equity shareholder, called as earnings available. Earnings available to equity shareholder. Earnings available to equity shareholder. Do you know what do we officially call it? We officially call it EAES, which means this is something which we can use even in the formulas, even in the exam. Earnings available to equity shareholder is what it is officially called as. Now this is the earning which is available only to equity, and from earnings available to equity shareholder, which let me put it down in green for you, right? From this earning which is available to equity shareholder, is it compulsory that you pay to them the entire amount in the form of dividend? The answer is no. This out of this total earnings which is available, a part of it I distribute in the form of dividend. Rest of it is there with the company, remains with the company, called as retained earnings. Retained earnings. Perfect. So this is broadly the format of income statement. You should know right from there till this point. It may happen that sometime you may be needed to prepare only this much of the income statement, sometime only this much of it, sometime maybe use a particular formula of maybe just 2 or 3 lines. Any possibilities there, overall you should know it. This is the format of income statement. Perfect. So some people want that, sir, we want your introduction. I'll introduce myself. But before that, let us first of all complete this topic. Fine, sir. Sir, the revenue which I generate from my operation. Cool. To generate that revenue, I have to incur manufacturing cost, admin cost, or maybe the marketing cost. All these costs are my operating cost. In fact, the depreciation related to this is the operating cost. So from the operating revenue, if I deduct all four operating cost, the profit that I get, people, is called as operating profit. Is called as operating profit. So you got an alternative terminology for EBIT as operating profit because, sir, please observe. Because, sir, please observe. The terminologies are equally important. It is not just the concept you should know. Examiner uses a particular terminology in the question. You should be able to connect to what he is asking or what data is given. And that we are going to make sure in these outnotes because it will literally have everything. Perfect. Nagendra Babu is asking, does the revenue include other revenue or just the revenue from operation? Nagendra, revenue from operation, because that is how AFM questions are designed. Other revenue like interest income or any other thing is not included. Perfect. But related to operation, all my revenue is included. All right. So for example, if I talk about operating cost, COGS, as I said, is my operating cost. Then admin general is the operating cost. Selling marketing is the operating cost. In fact, depreciation is my operating cost. So all these four costs I can call to be the operating cost. So which is why if we say from the revenue, when we deduct the operating cost, we get operating profit. Of all these expenses or of all these numbers that you see, can you all please tell me which particular item is a non-cash item? Come on, come on. Starting your day with the easy questions that you already done at C intermediate level, please identify in the entire income statement which item which is primarily is considered non-cash. Please. Sir, it is obviously the depreciation and amortization that is considered a non-cash item because when you incur this expense, you don't have to pay any cash. When you incur salary or rent or anything, you have to pay the cash. For depreciation, you don't have to pay any cash. Since it is a non-cash item, the profit before this item is called as cash profit. EBIT is not considered cash profit because depreciation is deducted, which is non-cash. But all other expenses like this, they are my cash expenses. I have paid that cash broadly from my pocket, which is why the profit that I get here is a cash profit, right? After this cash profit, I will deduct a non-cash expense, which is why EBIT cannot be called as cash profit, but EBITDA can be called as. So another terminology for EBITDA is cash operating profit. It is an operating profit, but a cash operating profit. Could you also understand the logic of cash operating profit, everyone, along with the operating profit, which means we should be comfortable with all the terminologies related to it. Come on, come on, come on. Waiting for your responses. Are you people 10 on 10 clear on everything that has been spoken so far? Come on. People in the class waiting. Are you people literally 10 on 10 clear? Yes, yes, yes or no. The next thing I'm going to explain to you are different kind of ratios. But before I proceed, I need a response. Any doubt, all the live and recorded people, let me tell you. Any doubt, silliest doubt. In fact, first of all, let me tell you, no doubt is ever silly. If I will tell you about my doubts, I used to ask to my teachers when as a student, you will end up laughing on it. So never be afraid of getting judged, by me at least. No doubt is ever silliest. Your doubt can help not only you, but a lot of, like, I mean, for example, this video will be ultimately watched by 1,000 people. So your doubt is going to help all those 1,000 people who are watching of this lecture. So whenever you feel there is a doubt, don't hesitate, even if it relates to C enter. Yes, this is a re-opportunity to make sure all our doubts are sorted. We are conceptually 10 on 10. Perfect. This is your responsibility. My responsibility too will be to make sure that your every single doubt is being answered. So no hesitation. Our class already have a very chill environment, very friendly environment. No hesitation at all. Perfect. Sir, taking your lead. So, there are some ratios which are based on income statement. For example, have you heard these terminologies called as gross profit margin, net profit margin, EBIT margin? What are they? They are the ratios. Sir, if we calculate how much is the gross profit as a percentage of revenue that I have made, for example, if I make 1,000 rupee revenue out of which COGS is 800, means my gross profit is 200. So if I calculate how much is my gross profit as a percentage of revenue, it is 200 divided by 1,000, which is 20%. Perfect. So we don't end up writing, formulas as a kid. Rather, we try to understand, how is this calculated. So when I say gross profit as a percentage of revenue, this is what, people? One second. Gross profit as a percentage of revenue is gross profit margin. Similarly, EBIT as a percentage of revenue is EBIT margin. Similarly, PAT as a percentage of revenue is the net profit margin. So let me write down the words. Sir, first was gross profit margin, next was EBIT or operating margin, next is net profit margin. So we are not only clear with the format of income statement, one second. We are not only clear with the format of income statement, but all the possible terminologies, all the ratio calculations, primarily the ratio calculations which are based on income statements, right? This is the first thing which you all need to understand very clearly, right? And now I will take you ahead to the next concept. Are we all set? So super fast, before I proceed ahead, I will very quickly introduce myself. So my name is Adish. Obviously you would know my name, Adish Jain. I'm a CA and CFA, so I completed my CA in 2016. So for CA, we have to do articleship. So I am from Indore. Have you heard of Indore city? Recently, there was a viral video of a politician making An abusive comment, I guess. So, anyways, that's how some people got to know Indore. Some people know Indore about its cleanliness. So, I'm from Indore. Okay. So, for my articleship, I went to Mumbai, did 3 years of my articleship, then appeared for final in May 16th, got cleared in the first attempt. Then I started to work in Mumbai. For 2 years, I worked 1 year in each company, Morgan Stanley and ICICI Securities, and the profile was equity research. Do you know what equity research is, everyone? Do you people know what exactly equity research is? Have you heard of it? Because if you love finance, then equity research, portfolio management, mergers and acquisition, investment banker, IPO investment banker, all these terminologies are going to be your dream profile actually. Frankly saying, dream profile. These profiles are core finance profiles. Really interesting, really interesting. You end up, analyzing new companies, understanding new business, attending meetings in different cities, meeting to the co-founders, CEOs, CFOs, or MDs of different companies. These are the profiles which are really fascinating. So equity research is exactly what? There are companies in the market, companies like TCS, companies like Wipro, companies like HUL or Reliance. You end up doing the research of those companies. You analyze those companies, understand the business model, understand business, understand competitors, environment, economy, industry. You understand everything about that company, analyze it. Then come to your conclusion regarding what should be the growth of the revenue of the company, what should be the future financial statements of the company, future profit, future cash flow, future balance sheet, and using those forecasted financial statements, you try to value the company. Valuation of the company, yes, that is a topic in our class in finance, yes. So that valuation, when you do, using that valuation, you ultimately come to a conclusion whether this company which is trading in the market at a particular price is a overvalued company or a fairly valued company or an undervalued company. Let's say, for example, share of TCS right now is 4,000 rupees. When I do that research, that analysis, that forecasting, that valuation, when I see that according to my calculations, the value of company should be 4400. So what is there is the current market price already there in the market. You can say market price per share. And what you calculate is the intrinsic value, or you can say target price. Theoretically, we call it intrinsic value. Practically, when you go to that world, you will end up calling it as target price. And using the CMP, the price which is already there, and using the target price, you'll be able to make your decision that something which is of 4,000 right now should actually be of 4400. It has a worth of 4400, and you will end up buying that security. So this profile of analyzing, share, making the valuation tables and everything, which is officially called as financial model, I'll tell you about it in my intro itself, right, is called as equity research. Perfect. So that is a core finance profile that I worked with, right? And obviously, when I come from there, I come from there with a thought process which will get automatically shared with you. You will find that difference in the approach that we study in the class as compared to any other class that you would ever see. Perfect. That comes automatically from the practical exposure. Because I know when you reach to that place where you have to practically deal with the companies, their data, their financial statements, their people, you have to project the financial statement. All those things, when you do, what kind of thought process do you need? And we will try to develop that thought process in the class right from day one. Yes. So as I was saying, I completed CN 16, then I worked in Mumbai with these two companies, ICICI Securities and Morgan Stanley, for 1 year each in equity research. And during this time, I started doing CFA. So fortunately, in every attempt, 17, 18 and 19, I could clear my CFA respective levels. Again in the first attempt, with the grace of God. And then I decided to come back to my hometown, which is Indore. So since then I've been teaching. So I teach to CA final students, as you people hire. I teach to CFA students, so I take the classes even for CFA, and I particularly also train financial modeling students. Sir, what is now financial modeling? What you learn here in this class, or in fact, what you learn in the CFA, despite it being practical, it doesn't match the requirement of what you need for the real world job. So financial modeling is actually a skill program where along with the knowledge that you have right now in the class, you develop that skill of actually preparing the real world financial models. Financial model is again what simply projecting the financial statements, future financial statements, then trying to do the valuation of the company, figuring out a target price, and then come to the investment decision of whether we should buy this share or it is overvalued, so sell this share. All that is financial modeling. So all that I have been doing now. My point of sharing the entire story is not to impress you, but first give you a confidence that when I come to you with the qualification of CACFA. I come to you with the real world finance exposure of equity research, and I come to you with the teaching experience of CACFA and financial modeling, which means I come to you with an experience, qualification, knowledge, background, skill of a lot of things, and I will try to make sure everything which is relevant for you, I will pass it on to you without compromising our mindset that ultimately exam is really important. We will focus on the real world things only to the extent that it is going to help you in the exam, not beyond that, because for now exams are really important. First. Second, I want to tell you that who is responsible to ultimately make sure that you end up liking a particular subject or you don't end up liking a particular subject. You know who's responsible? It's me. It's me who will ultimately decide whether you like finance as a subject or not, whether you like, or for example, your audit teacher or FR teacher will ultimately be responsible to make sure whether you like audit or FR or any other subject or not. Perfect. And the subject which you like or dislike ultimately decides the profile that you like or dislike. I didn't like audit as a person. So as a subject, I didn't like audit as a subject. So I didn't end up trying for the audit profiles when I qualified CA. But I really liked finance as a subject. So I end up choosing those profiles. Even if it took so many of efforts, I end up choosing finance as a profile, right? Because I liked finance as a subject. So which is what I'm saying. Ultimately, what you like today will somewhere shape your future. So it become my responsibility to make sure that you end up liking the subject, because the profiles which I talk about are really fascinating. I mean, the job of fund manager, where you own people's money, where you have people's money if you have to manage it by investing in different stocks and bonds, right? It's not a monotonous job. Every day market has a new story. Every day there is a different thing in the world happening. You have to analyze the impact of those things in the stock, in the economy, in the market, on the company, on the industry, and then again change your decision of whether which this company is worth buying or not, whether the price is expected to rise and fall. All those fascinating new tasks every day, interesting things you do only when you have such profiles. Yes. So I come to you with that experience, and I know how interesting that particular thing is, because I have experienced that, and I want to make sure you get a chance to experience that. You get those learnings, you get those skills in the class, that you can achieve those profiles real easy. That is why all that story has been there. Are your people aligned to me? Are your people, everyone in the class, please tell me aligned to me. Come on, come on, come on, tell me. Yes, everyone. What do you say? There? Just give me a minute. Let me have water. Then we continue. Just give me a minute. Yes, people. There, people. Are we all set? Shall we proceed? Come on, come on, come on. Respond to me. Then only we can proceed. Hello. Everyone in the class. There. So just one thing. Are you people 100% comfortable with my language? The way we speak? The way we do it in the class? Are you able to connect to it? Everything sorted? Yes, people. Harshada, Nagendra, Jashwant, Shruti. Other live people sitting here. Come on, other recorded people. Is that all comfortable? The language and everything? Yes, great. So we are done with PNL. Now there is one more equation or format of PNL or arriving at the net profit which we will learn in the later part when we come to that particular chapter. Right? Now taking you to certain ratios. Earnings per share, book value per share and return on equity. These are the ratios which are primarily based on financial statements. Right? So I will end up writing on the top of this page financial statements means balance sheet and income statement based ratios. All three ratios that we talk about are financial statement based. Meaning to say, if I talk about earnings per share, earnings per which share? Earnings per which share, boss? Which share? Sir, obviously earnings per equity share. Because earnings of preference share is fixed by way of percentage. A dividend percent for a preference share is fixed, right? But for earnings for an equity share, it is not fixed. It's a residual number. Whatever is left will belong to equity shareholder. Sir, please look at the income statement and tell me, of all the profits that you see, gross profit, EBITDA, EBIT, PBT, PAT, EAS, retained earnings, can you tell me of all the numbers that you see here on the screen, which number can be particularly said as the earnings which belong to equity shareholder? Come on, find it out at your own. Observe. Let's create the formula. Which number in your opinion is the number which belong to equity? Sir, is it the PAT which belongs to equity? No. PAT belongs to both equity. PAT belongs to both equity as well as preference shareholder. So is it the retained earning that belong to equity? No, sir. Retained earning is the profit left after distributing to equity. The actual number that belongs to equity is earnings available to equity shareholder. This is the total earnings earned by the company during the year which belong particularly to the equity. So of this earning, a part gets distributed called as dividend, rest of it is retained, but ultimately the earnings earned by the company for equity share particularly is EAES. Those who are thinking EAES, absolutely brilliant, was appreciable. So the formula of EPS become what? Earnings available to equity shareholder divided by. So I don't need the total earnings, I need the earnings per share. So if I divide the earnings, total earnings available with the number of share, I get the earnings per share. Such a common sense it is. Sir, if I talk about the format, can I say? If I talk about the format, can I say? From the PAT, if you deduct the preference dividend from the PAT, when you deduct the preference dividend, what you automatically get is earnings available to equity shareholder. Perfect. Just for you people to recollect. So if the financial structure, the capital structure of the company has preference share, then there will be preference dividend. If there is no preference share, if there is no preference dividend, can I say PAT and EAES will be one and the same only? Whatever PAT company earns will be all available for the equity shareholder, they will be same, which is why a lot of time you will observe that in the absence of preference share, institute and even we are going to use the formula of EPS as PAT divided by number of share, because there is no preference share in it. Logical? 100% logical calculation of EPS. Really simple. Sir, how is EPS practically used? That I will show you. Before that, you will have to give me some time. Perfect. Sir, what about value per share? Sir, whose value are we talking about? Again, the value of equity we are talking about. So, how much is the value per share? Is it the value which is there in the market price? No, no, no. The value of the share as per financial statements. Sir, if you imagine a balance sheet, we have equity, we have external liabilities, we have all the assets of the company. So, how much is the total value of the equity as per balance sheet is the first thought. And divided by number of share give me how much is the value per share as per the books of the company. We call it book value per share. So, first of all, let's find the total value of the equity called as equity shareholder fund, which is denominated using ESHF. You know what is the best part of the outnotes? Let me tell you. The definition of book value per share you will never need in the exam. Observe the beauty of outnotes, how you end up saving time. The definition of equity shareholder fund is never needed in the exam. Which is why if you observe, they are already pre-written. That if in case you want to read it, if you want to understand it, that is pre-written in a very crisp manner, compact manner. However, the formula is needed in the exam to solve the practical question. So, formula we end up writing. So, the things that you need to apply in the exam, we end up writing. But the things which you need to only understand for the sake of understanding, for your ease of learning, for your conceptual clarity, that is pre-written. It ends up saving your time. Because please, there is this difference you need to understand, that when we come to CA final level, there is a level of maturity which you should have. Now we are not a CA intermediate student where someone is going to hold your hand, make you people spoon feed at every step. Now I will learn, I will teach to you how do you become independent. How do you become so smart that just by reading something you are able to understand the meaning of it, and the formula for that we end up writing that we need to apply in the exam. It will end up saving your time. It is called as a smarter study, where in a lesser time you are able to get more. You don't end up missing in anything. We are anyways learning the definition. We are anyways learning the definition. We are just not wasting the time by writing it down because it has got no relevance for exam. Writing has got no relevance. Perfect. So, sir, for calculating book value per share, I need the total value of equity as per balance sheet, and dividing it with the number of share will give me per share value. But the total value is equity shareholder fund. And let me tell you, along with all the terminologies in the entire AFM, you will observe that how can something be denoted, like what abbreviations or what acronyms are being used to denote a terminology, right? All that has also been specified with this blue color that you observe here. These are official. You can use it in the solution in your notebook. You can use it even in the exam. Your marks won't be deducted. These are official. Perfect. So these minuteness have been taken care in the outnotes, which make your learning really easy. At any point after 2 years, when you look at the notes, you won't be confused that what is this written EIS or what is ESHF. Perfect. That is equity shareholder fund or the net worth, the total value of the equity shareholder as per balance sheet. Sir, how do we calculate it? Equity shareholder fund has two possibilities. One is you can total up the liabilities. For example, how much is the equity share capital? Plus, you can add reserves and surplus to this, including retained earnings. Minus. Sir, in the asset side, people in the class, in the asset side, if there is a unamortized expense fictitious asset or any asset which should be written off from the equity, for example preliminary expense unwritten off or any discount on the issue of bond or anything, right, then that is to be deducted. So we say equity share capital plus reserves and surplus minus unamortized expense, or I can say fictitious asset. This you deduct. Perfect. Another possibility, see, if this is my balance sheet, one possibility is I add up all the items in the equity. Another possibility, I add up all the assets, I take the total of assets, right? Minus I deduct external liabilities like debenture, preference share, all these when I deduct, I am automatically left with the balance of equity. So what is another possibility? Second possibility. Second possibility, you take all the assets of the company excluding fictitious. Yes. From the assets of the company, you deduct all the external liabilities. And you also deduct the claim of preference shareholder claim. So from the assets of the company, if you deduct the external liabilities and the claim of preference shareholder, what you're left is the balance of equity. Whether you follow this particular approach or you follow this particular approach, you will get the total claim of the equity shareholder as per balance sheet. And when you divide that total claim of equity shareholder, which is called as equity shareholder fund, with the number of share of equity, sir, you automatically get the per share value of equity as per books, calling it as book value per share. Everyone, please tell me, are you people clear with this particular thing before I take you all ahead? At initial level, to bring that comfort, I'll be a bit slower so that you are in the process of getting that comfort. Once you people will be comfortable, we will slightly gradually speed up. Come on. Waiting for your responses. Are you people comfortable with this? Please tell me. Just a minute. Come on, come on, come on, come on. All the recorded people also sitting in the class. Are you people 100% comfortable? If the answer is yes, we are all set. Sir, now we need to calculate a ratio called as the return on equity. Perfect. Before teaching to you this particular ratio, so let me tell you one important thing. When I taught to you book value per share, everyone in the class listen to me. When I taught to you this particular concept called as book value per share, did I read this definition in the class? No, because there is no need for that. But did I explain to you a context or a background for it before explaining formula? Very importantly, yes, and that is what you will have to remember to create the formula at your own. For example, I told you that how much is the total value of equity as per balance sheet. This is not a definition. This is just an understanding I want to share, and this is something you will also have to remember, which make you people not directly mug up the formula. Not that equity shareholder fund is equity share capital plus reserve surplus minus this. No, no, no. Try to understand. It is the total claim of equity as per balance sheet. Now you apply common sense that in the balance sheet, what belongs to equity? This. What else belong to equity? This. But if there is an asset unwritten off, you will have to write it off and deduct it from the claim of equity. That is a thought process, not a formula, if you realize. So when I say the approach that we're gonna have in the class is really different, the first example of that is this, where you don't learn a definition, no need. You need to learn the understanding, and based on your understanding, create the formula. Are you all aligned? The next understanding I'm going to share is the understanding of ROE, again for which you will create the formula at your own. My question to you is, suppose you invest 100 rupee in a business on which you get rupee 20 as the profit from that business. How much is the return you generate? If you invest 100 rupee in a business, if you earn 20 rupee out of it, my question to every single student sitting in the class here is, how much is the return percentage that you generate? Sir, really a common sense 20% return. That is what you are thinking. But how have you calculated 20? Or when I say you invest 200 rupee to a business and you end up earning rupee 30 of profit, how much is the return you generate? Sir, 30 divided by 200 give me 0.15 or 15% return. Correct? Can you please figure out at your own what are you doing to calculate 15%? What are you doing? Sir, you are simply dividing 30 with the 200. That is the common sense of return. You will have to always remember that whenever you have to calculate return, in the denominator, you take what have you invested. And in the numerator comes what have you earned on that investment. In the denominator is how much you invest. In the numerator is the return you have generated from that investment. So when someone say return on equity, can you please tell me in the entire balance sheet what is the amount of equity called as? The amount of equity investment as per the balance sheet, the amount of investment that you have made of the equity is called as what? Sir, we have just read, it is called as equity shareholder fund. Equity shareholder fund is that investment as per balance sheet that we have made in the business. Correct? We have to calculate return on equity. So first find out the capital invested by the equity. Then in the income statement, can you find out the profit which belongs to equity, the return which equity has earned? Sir, it is earnings available to equity shareholder which belongs to equity. So automatically the formula of ROE, you will have to never ever mug up. You have to just remember two things. First, that return on equity is the formula based on financial statement. Market price of the share, etc. has nothing to do with it. First. Second, return formula is really simple. In the denominator, you take the amount of investment as per balance sheet is called as equity, earnings, equity shareholder fund. And in the numerator, you take the return earned on that investment. So in as per income statement, the return earned is earnings available to equity shareholder. So automatically, everyone, the formula is on the amount of equity shareholder fund that I've invested, how much is the amount of return being earned automatically gives you ROE. Perfect. My next question to you all is, sir, if I divide the earnings available to equity shareholder, if I divide the earnings available to equity shareholder, just a second. Please tell me. If I divide the earnings available to equity shareholder with the number of share, what do you get? Sir, we get EPS. And similarly, even to the denominator, if I divide equity shareholder fund with the number of share, what do you get? Sir, book value per share. So this become an alternative formula of calculating ROE where the parameter are per share based. So we say that on a per share basis, the amount of equity that is invested in the business as per balance sheet is book value per share. And the amount of return earned by the company on a per share basis as per income statement is called as EPS. So EPS divided by book value per share also become the formula of ROE. There are two possibility. One is totality, one is per share, but they both, all three of them as per are based on financial statement or balance sheet, whatever you call it. Sir, my point is, are you able to learn it in a manner that you don't have to mug it up? You will have to please respond how much out of 10 are you people clear with what we have learned. Yes, how much out of 10 are you people clear? Come on, tell me, everyone. Yes, 10 on 10. Nagendra, Jashwant, every other live recorded people sitting here, are we all 10 on 10? Kanika, Harshita, recorded people really set. Great, perfect, sir. Next, moving to the next concept, market price and market capitalization. Perfect. So let me just, for the sake of interest, show you a practical world financial statement. Not that it is very important from exam, just on a lighter note. Give me a second. I know the screen is not visible. Give me a second. See, for example, if I go to the website of TCS, when I teach financial modeling, we have to also teach students that where can they collect the data for a particular company. So for a website, for example, TCS, I go to the investors tab, and in the investors, I go to the financial tab, and then I say quarterly earning report. So let's say for the year of 24-25, let's look at the annual report company create as per Ind AS. Let's look at the consolidated, right? So I've not opened the annual report. I'm just showing to you directly the financial statements. So when we talk about financial statements, our financial statement won't look like the complicated real world financial statement. For AFM, the financial statement look really easy. In the asset side, we have fixed asset, current asset, or it may call it plant, property and equipment or whatever, then stock, inventory, all listed up back to back. Then in the liability side, we have simple elements like creditors, like debenture, like liabilities or simple things. And equity also we have simple things. Perfect. But still, for your ease, you should know that when we call about equity shareholder fund, it is share capital of the company plus the other equity, or at some point non-controlling interest depending upon the situation. This is how broadly the financial statement we have to find the equity. Similarly, when it comes to the income statement, our income statement look entirely different from what it is there. But broadly, you have to see that we have revenue, then other income is not relevant for us in AFM. Then we have different kind of expenses there. Then tax expense, interest expense, and so on. Right? This is how the financial statements are. So if I ask you to calculate the book value per share, you will take the share capital of the company. You will take the other equity of the company, which include reserve, surplus, etc. things. So you will have the total equity shareholder of fund. You will divide it with the number of share and you will get book value per share. Whatever we have learned theoretically, although you won't need it in the exam, but on a lighter note, I wanted to explain to you, this is how you calculate practically. Are you people broadly aligned to me, what I'm saying? Perfect. My question to you all is, if this is book value per share, then what is market price per share? This particular share of TCS that I've talked about is a company whose book value we calculated. This particular share is getting traded in the market, is getting bought and sold in the market. Everyone, when you say market, what do you mean? Where market? For example, if you have to buy vegetables, where do you go? Vegetable market. Do you know what do we call it in Hindi? At our place, Indore, Sabji Mandi. Have you heard this word called as Sabji Mandi? Do you know what does it mean? How many of you understand Hindi, by the way? Just out of curiosity, I wanted to ask. Do you people understand Hindi or not really? Not really. Harshita, you do. Do you people know what Sabji Mandi is? Thoda thoda you understand Nagin Bhau. Jashwant, you don't understand it at all. Fine. Great. No problem. So, if you have to buy vegetables, you have to go to vegetable market. If you have to buy gold, you have to go to gold market. Similarly, if you have to buy sell shares of a company, you have to go to the share market in India. There are two national level share market, stock market called as National Stock Exchange and Bombay Stock Exchange. For example, this is the market I was talking about, National Stock Exchange, the place where the place where shares are getting traded, right? Today being Saturday, so market would be closed, right? But despite that, for example, when I go to this particular place and search TCS, I get Tata Consultancy Services. Oh, what's the error? Wait. TCS. There's some error, unfortunately. Hold on for a second. So website must be having some maintenance. Let me show you the other website. Bombay Stock Exchange, BSE, the another market, right? There also I can search the same company. So this company which is TCS is getting traded in both the markets, right? The price of the share of the company, which means the price that people are ready to pay in the market for this company, is 3250. When I buy a share, I'll have to pay you 3250 is its current market price, which is there in the market, and which is what we were trying to learn in the next concept here, which is what we were trying to learn in the next concept here, called as market price per share. It is the price per share that prevails in the market or in the stock exchange is market price per share. And what is the market cap of the company? Sir, market price is the price of the share in the market on a per share basis. But as per market, what is the total value of the company? What is the total value of all the shares of the company? Total price of all the shares of the company is the market cap, which is simply, if you observe, is number of share multiplied by the market price per share. Such a common sense it is. So in the entire AFM, please observe, we will use N for number of shares. First thing. Second, in the entire AFM, when you have to use market price of a share, it will be called as MPS. We have to use the total market capitalization, it will be called as MCAP. This you can officially use. Perfect. So total market price multiplied by the number of shares, the market value, called as market cap. Sir, let's say we have a company having 1000 share, where price per share in the market is 15. So 1000 multiplied by 15 is 1000 share multiplied by price per share 15, give you rupee 15,000 as the total market value of the company, called as market cap. This market cap is also called as total market cap or full market cap, but there is one more terminology you should know, called as free float market cap. Boss, do you know what a free float market cap is? Can anyone share? Do you have an idea of what it is? What do you all say? Come on. Let me try to find this for you. Can you observe? Full market cap 11,75,000 crores. Free float market cap only 3,30,000 crores. Sir, what is this? Yes. So let me tell you. Shares of the company are being held by the promoters of the company, right? Who are the initial founders of the company, who are maybe the managers of the company, and some part of the shares, some shares are also held by public in general, people like you and me. So, for example, let's say out of the 1,000 share of a particular company, 700 are being held by promoter 30%, 300 are being held by the public in general. So we can say that 30% holding is public holding and 70% holding is promoters holding. So the market capitalization which belongs to all the shares is total market cap. But the market capitalization which belongs to only 300 shares which belongs to public is free float market cap. Sir, why do you call it free float market cap? If you understand it, you will have to never muck it up. Do you agree? Do you understand that the shares which are getting traded in the market are not all the shares? The shares which are held by the promoters are not traded on the stock exchange. Only the shares which are held by public in general are traded on the stock exchange. So only these 300 shares are freely floating in the market, freely getting traded in the market. Sir, they are called as free float market cap. So free float market cap will simply be number of share number of free float share multiplied by MPS. Please understand, this is not even a formula, this is a common sense, that 300 are such shares being traded. 300 multiplied by 15 give me 4500. 4500 as the market cap, free float market cap. There is one more way to calculate it. What is the way to calculate it? Sir, we can say that whatever is the total market cap of the company, of the total market cap, which is 15,000, of this total market cap, can I say 70% of the market cap belongs to promoter, which means 30% is the free float market cap which belongs to public in general? So of the total market cap, if I multiply free float holding, then also I can calculate free float market cap as, sir, 15,000 multiplied by 30% is 4500 rupee again. Do you agree with both the methods? Yes, sir. Similarly, there is no need to write it down here. Or maybe you can end up writing with pencil on a lighter note that if I have free float market cap, can you divide free float market cap with free float holding? In percentage terms to find the total market cap? Let me also add percentage here. Here, yes. So can I say that if my free float market cap is 4500, which I know is equal to 30%. So 4500 divided by 30% obviously gives me the total market cap of rupee 15,000. This is not the main formula. This may be the main formula that, but in some practical questions we might have to use this particular formula. So it is worth to write it down, even like maybe by using pencil, but it is worth to write it down. Settled? Are we all? Is it making sense? Perfect. So we have learned that in the market there exists a price called as market price per share. The price as per the books is called as book value per share, right? So just for your understanding, equity shareholder fund is the value of equity. Market cap is also the value of equity. Just that as per market, the value is called as market cap, but as per books, the value of equity is called as equity shareholder fund. Logical? The total value of equity as per books is equity shareholder fund, and as per market is market cap. On a per share basis, I can say the equity shares market value is market price, and per share value is the book value per share. Yes? Please tell me, are you people 10 out of 10 settled on this? At every step, I would validate if you are settled 10 out of 10 on this or not. Come on. This is how the approach is going to be. Although we are a little slow in the initial few lectures till your comfort on the subject on me is developed, then they will slightly speed up. But faster you respond, the better lecture goes. Are you able to connect to everything? Great. So my next question is, do you people feel like taking a break? Do you need a break? On an everyday basis, or no break? Just 3 hours of continuous study every day. What do you want? You must be like, sir, if you want us to be alive, then at least we need a break to have the breakfast. Yes, very much needed. So it is 9:50 right now. Let us take a 10 to 15 minute break. Let's meet back by 10:05. All right, let's take a break. Let's meet back by how long break do you need? 5 minute, 10 minute, 15 minute? What do you need? 10 to at least I would suggest. For today, let's meet back by 10:05. 15-minute break. Then over the time we will figure out. Cool. So bye everyone. See you all after 15 minutes. Please be back after the break live only so that we are able to continue our learning. Yes. Bye everyone. See you all. So one thing, if you've not gone, one thing. Live people you may go. Recorded people if you're still watching it. So maybe, is it? If you're still watching it, if you face any particular issue or anything, right? Live people also, if you're watching me, you can, so first of all, I would suggest you to everyone, write down my WhatsApp number 70457489555. I mean, you must save it. Reason being, I will have obviously your numbers, you have registered it. At any point, if I feel like contacting to you people, sending you a broadcast or anything, I'll be able to send you the broadcast only when you have my number saved. First thing. Second, I will also share with you how can you ask me doubts. Is it this WhatsApp number on which you'll have to send me doubts, or is it a Telegram group for which the link I will share? We will figure that out. So live people, recorded people, if you're listening to me, please note down my official WhatsApp number. No calls, only WhatsApp. All right. Other than that, if you need the technical assistance or anything, I will give the number of tech team or support team in the description of this video. Fine. So now go for a break. Bye. See you all at 10:05. Okay. Guys, am I audible? Visible? Is everything fine? Are you people there? So Manupati is saying my attempt is in Jan 28. Can I join this batch? Absolutely, yes, you can join, and you must join, because if you start AFM now, then there will be other subjects also to cover up. So joining now is the best time, so that you have sufficient time left even for the revision. Perfect. So great. We have to now come to the next thing, which is on the P ratio. We are back from, we had done before the break MPS and market capitalization. Now we'll talk about the P ratio. So during the break, I was just saying to the live people and to the recorded people that you can have my contact number in case of any emergency, you can connect. For the doubts, I will guide you in the next few days how should we connect, either on the Telegram group that you will receive the link for, or through the WhatsApp. One of the two possibilities, I will guide you where exactly to ask the doubts. Right? Next point is learning P ratio. Sir, where is your contact number? WhatsApp number is there in the description of this video. Perfect. Sir, talking about the P ratio. Formula, all of you would know what P ratio is. In fact, the name itself has the formula. Name is price to earning ratio. The formula itself is price in the numerator, earnings in the denominator. So when it comes to creating the formula, it's really easy. That's our P ratio is equal to MPS. Price per share is MPS and earnings per share is EPS. Yes, perfect. Sir, what about the otherwise usage of this formula? Is it possible that examiner might give us P ratio, examiner might give us EPS, using which we have to calculate MPS? Very well possible. It may happen that we are being given EPS of the company, we are again given the P ratio of the company, using which we have to calculate MPS. The formula of P is really easy. The meaning is more interesting actually to learn. For example, they say the P ratio. P ratio is 24.85. Let's look at the standalone P ratio, 24.85. Do you know what does it mean? It actually means 24.85 divided by 1. 24.85 divided by 1. It means that for every 1 rupee that company earns on a per share basis, that every 1 rupee company earns as a profit on a per share basis, people are ready to pay 24.85 rupees in the market for that 1 rupee of earning they will receive. You have to first pay a price, then you receive the earning. So if you want to receive 1 rupee of earning of the company, then people are ready to pay in the market. Then you are ready to pay in the market a price of rupee 24.85, which means every 1 rupee earning is trading at 24.85 rupee of price. So accordingly, suppose this is this particular company, which has a PE of 24.85. Let's look for another company comparable to it. Let's name it as TCS. Wait. Let's say Infosys. Right? Infosys, as you see here, the P ratio is 24.87. So the P there was 25, the P right now is 24, which means for 1 rupee of share, 1 rupee of earning, people are ready to pay 25 rupee of price for TCS, whereas 1 rupee of earnings, for 1 rupee of earning of Infosys, people are ready to pay 24 rupees for Infosys. So P ratio help you to somewhere understand if the company is overvalued or undervalued. Although practically there is a lot more detailing, but for AFM level we can say PE ratio help you understand if the company is undervalued or overvalued. For example, if a company has 25 PE ratio, and if a company has 24 PE ratio, TCS and Infosys, my question to every single student sitting in the class here is, given a choice, which company will you purchase? Let's try to figure out if we are able to have that common sense or not. Which company out of the two companies there here on the screen, which one will you purchase? Come on. What do you all say? Recorded people, come on, come on, come on. Will you purchase TCS because it has a higher price? No. You will purchase Infosys because of the lower price. The common sense is really simple, that in the denominator it's earning. So you are irrespective going to get 1 rupee of earning. You are irrespective going to get 1 rupee of earning. Yes. To get that 1 rupee of earning, for Infosys, you will have to pay 24 rupee. For TCS, you will have to pay 25 rupee. So what is the point of paying 24 rupee? It is better. What is the point of paying 25 rupee? Let's pay 24 rupee. That should be sufficient. So what I say, when it comes to buying a share, lower PE ratio is a better deal. That you have to understand, sir. One second. When it comes to buying the share, lower PE is better. When it comes to selling a share, higher PE ratio is better. Are you getting it? For selling a share, a higher P is better. For buying a share, a lower P is better. Sir, that's how the P is used sometimes for the decision making in the practical world as well as in the AFM. Perfect. Practically, there is a lot more to discuss on the PE ratio, small ratio, but really tells you great story. But this is not the time. Sir, we will now talk about dividend, absolute and percentage. Just out of curiosity, I want to tell you, I was just yesterday's Business Standard. I was just reading, and do you know, recently there have been multiple talks on investment on gold and silver. Just randomly sharing a small story. So I had this discussion with my father actually, because I belong to a family, I belong to a place where my fathers or maybe uncles, they don't believe investing in shares or all. They simply believe investing either in gold or maybe land. The traditional Indian investment, that is what they believe in. So I was talking to my father another day and he was like, since the gold prices have really been high these days and the silver prices, he was like that this is why we have been investing in gold, because that is always considered as a better investment, and in the recent years it has actually turned out to be a better investment. Yesterday only I was going through Business Standard newspaper, right, where they were trying to explain that if you invest 100 rupee, right? So let me show you the image of that actually. So not now, towards the end of the lecture, I'll take a moment, show you the image exactly to tell you that in 1985, I guess, 100 rupee if invested in the gold become this. 100 rupee when invested in become silver, this invested in silver become this. And the same 100 rupee if invested in the stock market, the Nifty, it become this. That is the power, or that is the return the stock market has given over the year. In a particular year, it may happen that a particular asset class like a bond, like silver, like any currency or a stock or any other commodity give you particular return. But overall, over the years, which asset class has given what kind of return, that I will show you in a chart towards the end of the lecture. Reminding will be your responsibility. It may happen that I forget. So remind me, I'll show you that chart. Okay. Anyways, back to the point. Sir, learning about the dividends. It just came to my mind while I was explaining to you dividends, so I thought of sharing. Sir, dividends. Dividend, you know what it is. The total amount of dividend that company distributes is this particular dividend I'm talking about, right? When you have the total amount of dividend and if you divide it with the number of share, you get dividend per share. Yes, common sense. Equity dividend paid divided by number of share is dividend per share. Such a common sense, extremely simple common sense, fine. This dividend per share, which is right now in absolute terms, maybe in rupee terms or dollar terms or any other currency terms, can be represented in percentage as well. So for example, when you represent the amount of dividend as a percentage of its face value, we call it dividend rate. For example, dividend rate is simply what? Dividend as a percentage of face value. Dividend as a percentage of face value is dividend rate, right? So similarly, sir, if we have been given the face value, if we have been given the dividend rate, can we find out the DPS? Obviously, yes. The same equation can also be written otherwise, that face value multiplied by dividend rate, which is in percentage terms, is equal to the amount of DPS. Perfect. Similarly, the dividend can also be presented as a percentage of MPS, this dividend per share. So whenever you hear this word yield, yield simply means return, right? It can be dividend yield, it can be earnings yield, it can be any yield. The word yield means return. And always remember, yield is a return based on market price. Return on equity is also a return, but that is a return based on the financial statement, that based on the book value, not the market price. Dividend yield or earnings yield or any other yield that we learn in AFM, they are also yield, but that is based on the market price. So dividend yield is the amount of dividend as a percentage of MPS. So I will say dividend yield is DPS divided by MPS. Relative to the price that a share has in the market, how much dividend it has distributed, the same thing can also be understood as MPS multiplied by dividend yield, everyone, is equal to DPS. Easy, basic, logical. Do you know what are we doing? With this discussion, if you realize, actually we are compiling. We are compiling all the basics at one place so that we don't have to struggle later in any practical question. Sir, dividend payout ratio is as a percentage of EPS. So we say dividend payout ratio is DPS divided by people in the class EPS. DPS divided by EPS. So if my company, for example, has 5 rupee of EPS, out of which company has distributed 2 rupee, can I say 3 rupee in that sense gets retained? So 2 rupee of dividend divided by 5 rupee of EPS give me 40% as my dividend payout ratio. So similarly, 3 rupee which got retained out of 5 give me 60% as my retention ratio. So our dividend payout ratio plus retention ratio is the total which is equal to the 100%. Which is equal to the 100%. So dividend payout ratio is DPS divided by EPS. Similarly, I can say retention ratio is equal to retained earning per share divided by EPS. Perfect. Sir, this formula can also be used otherwise. If I have EPS, if I have dividend payout ratio, I can find out the amount of DPS. Point is, you should be always be able to remember that. Dividend payout ratio plus retention ratio is always equal to 100% or 1. The two ratios always sums up to 100% or equal to 1. Sir, is this basic also clear to you all? Are you all able to connect to me? Please tell me. Waiting for your responses. Just a second. Please. Are you all able to connect to me? Can you all please tell me, were the three ratios based on dividend, were they all a part of your learning at CA inter level? Please confirm. Were they all a part of your learning at CA inter level? What do you all say? If you allow me, I want to make it look better. So if you have written it down, no problem. I just want to make it look better. People, sir, why are you asking? Some people must be thinking, why are you asking the questions which we don't even remember? We don't even remember, sir, what was the part of the curriculum at CA Inter and how have we cleared Inter, that also we don't remember. Is it the case? So now we are done with the basics related to dividend per share. Also, one particular thing I want to explain, right, is a basic thing, maybe of use in some practical question. But the point is that suppose this is the time, on this axis is the time, and on this axis is the price. If you look at any chart, it's a time price chart, right? On the x-axis, if you observe, is the time. Perfect. For example, if I look at a 3-month chart, on the x-axis we have the time, on the y-axis we have the price. Perfect. So similarly, if you draw a time price chart, you will observe that suppose this is a share price, right? This is the day on which dividend gets paid, right? So by the amount of dividend, the share price falls. By the amount of dividend, the share price falls, and again it continue to be there in the market. The point is that whenever company announces the dividend, common sense is that whenever company pays the dividend, that much amount of cash on a per share basis goes out of the company and reaches to the shareholder. So value of the company, the share price of the company decreases by the same amount theoretically by the amount of dividend, because that much amount of cash has gone out. So this price out here, this price here, which includes the effect of dividend, is called as cum dividend price. And this particular price is called as ex-dividend price. When the amount of dividend gets excluded from the price in the market when the dividend is paid, such price is called as ex-dividend price. That is what you all need to understand. Are you people clear, aligned to me? Yes. The reason we have to know is that terminologies are really important. Sometimes examiner says dividend price or come dividend price. You should be able to connect to what we mean to say. Sir, I have not explained to you how does it practically work, because in the practical world we have the announcement date, we have the record date, we have the transaction date, multiple dates are there. But for the purpose of solving the practical question, this much is needed for us. Perfect. Great. Because one thing is really clear, even if I show you the practical things, I will never write it down in the notes for you, because in the notes you should have the things which you need one day before the exam. In those 1.5 days, the concise notes you should have ready with you, which have only relevant thing written down, not anything which is extra. Sir, now we have the next page which has other ratios. What is this page for? Across AFM. When you go to the practical question, you will come across certain ratios which are used only in those particular questions, like debt to equity ratio, like gross profit ratio, sorry, not the gross profit ratio, like asset turnover ratio, debtor turnover, inventory turnover, leverage ratios. So when we come across these ratios in different practical questions, we will write those ratios here on this particular page. We will also give the reference of question number and page number here. So what happens? One day before the exam or on the exam day morning, if you are worried that, sir, what about different ratios or different formulas that I've read across AFM, you won't have to take any tension. You read this particular page, all the ratios across AFM and any practical question we have, you will be able to revise it on the exam day morning only through this one particular page, which is why this page is there. Yes, someone is asking me to explain this particular part again. Let me explain. Just one. Let's imagine that share of a company is getting traded. The company announces a dividend, company pays the dividend. Do you agree by the amount of dividend cash will go out of the company? Hello? So the value of company on a per share basis should logically, ideally fall by the amount of that cash, because that much cash has gone out, it has reached to the shareholder. So the share price, the market price, which represents the value of the company, do you agree? When the value of the company falls by the amount of cash, then the share price, which is nothing but the value, should also fall by the amount of dividend. So that is why we are saying when the company pays the dividend, announces the dividend, we are keeping a simple date for both the transaction. Announcing, paying is the same thing. When the company pays the dividend, right, the share price falls down, theoretically at least, by the amount of dividend on the date of payment. That is what that excluded share price is called as ex-dividend price. Could I explain it just one to you? Are you now settled? Others in the class, are we all 10 on 10 set, please? What do you all say? Recorded people, are we set? Perfect. So this gets done. Other ratios we will talk about in the later part. Now I'm going to explain to you the rates of interest or the rates of returns. Yes. Starting with the required rate of return and then to the expected rate of return. Have you heard these words called as required and expected rate of return? And in your understanding, are these words different or the same? Let's understand them one by one. Sir, if you invest in FD, if you invest in gold, if you invest in the share of TCS, or if you invest in the Bitcoin, will you want to earn the same rate of return from all these investments? People, if you think, you evolve. So as I said, in the class, I will make sure you learn to think, and these are the questions when I put up to you you learn to think? Please tell me. When you invest in these security, what is your requirement to earn? Will you want to earn the same rate of return on all these securities or a different rate of return is my simple question to you all. Come on, tell me. Please, please, please. What do you say? Everyone, please participate. Live people, recorded people. You would want to earn a different rate of return, right? For example, on FD, you would want a different rate. On TCS, you would want to earn a different rate. On Bitcoin, you would want to earn a different rate. Please understand my question really carefully. I'm not asking what rate of return will they give you. I'm asking what rate of return will you want from it. These are two different things. One is what you want, another is what it gives to you. If you want different rate of return on different securities, can you please try to answer my next question? On which security you would want to earn a lower rate of return and on which asset you would want to earn a higher rate of return? Please answer this question now. And automatically you will realize that you already know the finance. You just have to understand it that way. Please. Please. Waiting for the answer from you people. I know you people have understanding to answer it. On which asset you would want to earn a lower return and on which asset you would want to earn a higher return? Most of you would think that on FD, sir, we are okay with a lower rate of return, but on Bitcoin, we want a higher rate of return, which means the best part is the intuition of finance is already there in you, is inherent to you. I just need to only explain that institution. Sir, why do you need a higher rate of return on Bitcoin and a lower rate of return on FD? Please answer this particular question and you will end up creating the concept at your own rather than me explaining it. Why? Can you find out why do you need a lower return on FD and a higher return on Bitcoin? Why? Because of one particular thing called as risk. If you are intuitively able to feel that word, then you are on the right track. I would appreciate those who could think, sir, required rate of return means when I invest in any security, when I invest in any asset, whether it is real estate or gold or bond or share, or in fact any project of buying the machines, capital budgeting project. Sir, whenever I make any investment, I make that investment because I want to earn a return. Nothing is charity. So the rate of return I want to earn on that investment is called as required rate of return. And the required rate of return depends on the risk I take. If I take a lower risk, I need a lower rate of return. If I take a higher risk, I need a higher rate of return. So first of all, the meaning of required rate of return is the minimum rate that you require to earn, need to earn. And the best part is it depends on people. It depends on simply the risk you take. Higher risk, higher return, lower risk, lower return. And you know what is the more important thing? Sir, suppose we know the required rate of return. What is its use? Its use is really important. Its use is extremely important. It is used as a discounting rate to discount the cash flows. Sir, what are you saying? When I go to this particular topic in chapter 1, then I will explain what is the exact use of required rate of return. For now, you can just mark it that it is used as a discounting rate. Perfect. So any rate of return that you talk about actually has three components. One is the real risk-free rate, then is the inflation premium, then is the risk premium. Sir, what are you saying? Let me explain. Sir, let me explain. It may take a few minutes more, but it will give you the conceptual clarity to a very next extent, the next level. Let me create that example for you. Sir, You have given to me 100 rupee today. We stand at 0 here. You have lent to me. I have borrowed from you 100 rupee. I am ready to give you back an amount after a year. An amount I have agreed to pay you back after a year. My question to you all is, I am ready to pay you back 100 rupee. You gave me 100, after a year I give you 100. Are you okay with it? Super fast. Are you people fine or okay with it? Sir, obviously no. Why? Because sir, we want to earn interest. That is what we have learned from CA foundation level, that when you lend to anyone, you deserve to earn an interest. Agreed. But why do you deserve to earn an interest? Or why do you deserve to earn a return? Because of three reasons. Because of three reasons. You would want to first earn a rate. That is your earning, because when you give me 100 rupee, I am using your money. So when I use your money, I have to pay you for that. When I use your car, I have to pay a rent. When I use your house, I have to pay rent. Similarly, when I use your money, I have to pay interest. So I will pay you interest. That is the real rate I have to pay you. Perfect. So suppose I agreed to pay to you 5%. So I will pay you 105. So today you give me 100, but after a year, I pay you 105. But you know there is a problem. Suppose in market today, when you go, you are able to buy one apple for 100 rupee. But inflation in the economy unfortunately was 10%. So same apple, when you go to buy in the market after a year, it is turning out to be 110. Please think practically. You have earned money by lending it to me, or you have lost money by lending it to me. Think practically. Sir, today if you go to market, you can buy an apple for 100 rupee, but tomorrow if you go to market after a year, even if you have 105 rupee received from me, you won't be even to buy even a full apple, even one entire apple you won't be able to buy, because it is for 110 and you have only 105. Despite earning from me, you could not earn. Could you realize this simple point, everyone? Perfect. So what you need from me overall, everyone in the class, is that 5 rupee of earning is the real risk-free rate, and over and above that, you also need the compensation for loss in your purchasing power. That 100 rupee could earlier buy one apple, but the same apple is now for 110. So you also need the compensation for loss in the purchasing power. You need an inflation premium over and above that. So for example, if you get a total return of, for example, 10 plus 5, 15%, then 10 has gone to the 10 has gone to maintaining the purchasing power of 100 rupee. One apple is equal to one apple only. What you have earned effectively in real terms is not 15%. Even if I pay you 15, you will still be able to buy only one apple, and over and above that, you have 5 rupee in terms of your real earnings, in terms of your actual earning which you could made. Could I explain to you? That overall return you would want to earn from me is 5 rupee of actual return you wanted to earn, plus 10 rupee of inflation premium to maintain the purchasing power of your capital of rupee 100. Everyone, could I explain this particular thing? Please tell me. Super fast, yes, no. Yes or no? So the rate you earn for usage of money is the real rate. Over and above that, you want to earn inflation premium. And over and above that, if you have taken any risk, you would want to earn a risk premium, because as you said, when you invest in FD, you want a lower return. But if you invest in Bitcoin, you need a higher return, because when you take a higher risk, to be compensated for that higher risk, you need a higher return, and the extra return you earn for taking that extra risk is called as risk premium. One by one. If there is no risk, now I'm summarizing everything. Now you'll be able to understanding and everything in depth. Let me start. Let's say there is no risk. You invest your money, you lend your money to the government. I am government, I am RBI, I can print notes. You don't have any risk. You give me money, I will 100% pay you back. Your money will never be lost because I have the currency printing machine. Even if I am short of money, I will print the currency and pay you your money back, which means you have no risk. Still, you want to earn something from me because you have allowed to use your money. You have allowed me to use your money. What you want to earn is a real risk-free rate. First of all, it is risk-free. And second, it is without the effect of inflation. However, if there is an inflation in the economy, then you will not only want to earn 5, but you will also earn 5 and 10. Because you want to buy an apple after a year and then you want to earn. So 10 rupee extra to be able to buy the same apple, and 5 rupee extra because you have allowed to use your money. You allowed me to use your money. And then, sir, if there is a risk in that investment, rather than giving that amount to the government, if you give that amount to me, or if you give that amount to the TCS or invest it in the Bitcoin, there is a higher risk. So for that higher risk, if you don't get higher return, then why will you give the amount to me? You will continue to give the amount to the government so that you can earn the same return. If you want only when you get extra return, then only you give that amount to me. You take the higher risk, you give the amount to TCS, and that is why you require the risk premium. It means the extra return for taking extra risk is the overall discussion of your required rate of return, which has three parts. What overall you require to earn is the real risk-free rate plus the inflation premium plus the risk premium. People in the class, you will have to now particularly respond, could I explain, yes or no? The answer may be no, because I didn't want to explain it in unnecessary depth, but broadly you should have the idea, which is why we had this discussion. Super ultra fast, please respond to me. Only when you respond to me, we proceed ahead. Could I convey? Yes or no? Or if there is any doubt, you may please ask. Come on, come on, come on. Waiting for your responses. How much out of 10 are you people settled, that you tell me? How much out of 10 are you people settled? The clarity of concept is our main focus. The understanding of the concept is the main focus. That approach is really important. Understood? So, sir, if I ask you my required rate of return, and in fact, any rate of return has three components. Sir, what are the three components? The three components are really simple. They are real risk-free rate, the rate of return you want to earn if there is no inflation, if there is no risk. If there is inflation, we want to also earn inflation premium. And if there is a risk, we want to also earn risk premium. So this is how my total required rate of return is. If there is no risk, then I am fine with not earning risk premium. But I need the real risk-free rate and I need the inflation premium. You know what is this rate called as? What is this called as? This is called as nominal risk-free rate. Do you know what does the word nominal means? In any rate or in any cash flow, which is excluding the effect of inflation, is called as real. When you add the effect of inflation to it, it is called as nominal. This is nominal because it includes the effect of inflation, but it is still the rate which is applicable to an investment which has no risk, which is why we call it risk-free rate. Perfect. However, if there is a risk to it, right, also, then this rate, everyone, will be called as nominal risky rate, which means the rate applicable to those, the rate which has the effect of inflation, which is by nominal, and rate is applicable to those assets which has risk also, like Bitcoin or anything other than government security, which is why we call it nominal risky required rate of return. Basically what we are learning is the rate of return, required rate of return. So what you require on a risk-free security is a nominal risk-free rate. What you require on a risky security is a nominal risky rate. Perfect, you can call it risk-adjusted rate, one and the same thing. Fine, sir. So this was your required rate of return. Another is expected rate of return, which is also really simple. Sir, expected rate of return means how much do you think that particular security will be able to give to you? How much do you estimate? How much do you forecast the security or the asset will be give to you in the form of return? And please observe, there is a difference. Required rate of return is how much you want, but does that mean you will get what you want? No. For example, Bitcoin, or for example share of TCS has risk. So which is why due to risk you want to earn 14% on it, because you feel that bank FDs are giving 8%, which has significantly lower risk. So at least the share of TCS should give me 14 because it has so high risk. After buying share, the share is traded in the market. Now you feel that it is a possibility that in future Trump may impose some restriction, or maybe the Indian government say impose some restriction on the export of IT services. TCS is an IT company, it is exporting the services in US, UK, etc. If there is any conflict between the two government, then do you agree the company is going to significantly suffer? So we feel that the share price, which is right now 3500, tomorrow after a year it may become 2800 due to that intergovernment issues. So in that case, due to risk you wanted to earn 14, but you are estimating, you are forecasting that the share price, which is right now 3500, will become 2800. So how much do you think you will be able to earn the return? Even if you require 14, but do you think you will be able to earn a return of 2800 minus 3500 divided by 3500 as negative 20%? The purpose of this example is to make you people understand clearly the difference between two things. One, what you need is required, and second, what you get or you may get is expected. Expected rate of return is an estimate of return that you think you'll be able to get. It is calculated using the estimated price. For example, I stand at 0 year, this is 1 year. The price, the MPS of the share today is 100, but I am expecting or estimating the MPS after a year to be 110. In fact, I am estimating the dividend per share, right, to be ₹5 during the year. So overall, if you ask me, how much is the return I'm expecting to earn? So common sense remain really simple. The price, in the denominator comes the amount I invest, and in the numerator comes the return I earn, right? Sir, let's say we call it P0. Let's say we call it P1. So automatically the formula of expected return become P1 minus P0 plus dividend divided by P0. Let's look at the common sense. The formula is a common sense. In the denominator comes the amount I invest. What I invest is 100. In the numerator comes what I earn. What I earn is two things. One is capital gain. Investing 100 and expecting to redeem 110, so capital gain, which is P1 minus P0. And I also expect to earn a dividend of ₹5. So total earning is 10 plus 5, 15 rupee against an investment of 100. So if I observe the return calculation, It is 110 minus 100 plus 5 divided by 100 is equal to 15%. So I am expecting to earn 15%. Now it may happen that my required rate of return on this was maybe 20% or just 10%. These are two different things is what you have to understand, and along with that expected rate of return gets explained. People in the class, at this point again, I would want you all to validate if you are settled with this or not. Come on. Please, 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 please. You will have to validate. Are you people 10 out of 10 settled on this particular thing we have discussed? What do you all say? Please. First, three things you should be settled about. Difference, meaning of required, meaning of expected, and the difference between the two, and third is formula of expected. Any discomfort, slightest discomfort you may ask. So simply the return I think I will be able to earn depends on the price I think it will be and the dividend I estimate it will be, and accordingly I can calculate the return it will be. Perfect. Sir, this expected return actually can be broken down into two parts. I'm waiting for your responses. In the meantime, I'm continuing to explain, right? Sir, one part is called as capital gain yield. Another part is called as dividend yield. Sir, mathematically, can I break it down as P1 minus P0 divided by P0 plus D divided by P0? Can I break it down? So it is like capital gain yield is P1 minus P0 divided by P0. Guys, it seems there is a lag. I received your response, but a very delayed response, frankly. Just a second, huh? Yes. So guys, there's a delay in the response. Shruti, what is the status? Are you able to connect? Harshita, what is the status? Nagendra, Jaswant, other live people sitting in the class here, are you all 10 on 10 on this? Can we all proceed with this? What do you all say? All the recorded people, are we all connected? Perfect. So sir, mathematically, can I say P1 minus P0 divided by P0, this is one part, plus rest of it, can I say it is D divided by P0? So D divided by P0 is nothing but dividend as a percentage of price, which is nothing but my dividend yield. So sir, expected rate of return actually has two components. One is capital gain yield and another people in the class is dividend yield, which in terms formula is P1 minus P0 plus D divided by P0 broken down into P1 minus P0 divided by P0 and D divided by P0. I am saying if you understand not the definition but the meaning or the understanding, then you will have to not mug up anything at all except for say 5 to 6 formulas in the entire AFM out of I can say 50 formulas. Yes. Nagendra, there's some network issue from your end. Probably it may happen. Cool. So perfect, sir. That is required and expected rate of return. Now we have to understand something called as internal rate of return. Internal rate of return, right? Internal rate of return is actually a technique. IRR, people in the class, it is a technique actually to calculate the rate of return. Sir, when life of the investment is 1 year, the rate of return calculation become easy. that I invested 100 but it become 110, I also get 5. When the life is 1 year, the calculation of return become easy, but when the life is more than 1 year, the return calculation become a bit difficult. For example, let's say this is 0 year, 0 year, 1 year, 2 year. What you invest is 100 rupee. Yes, sir, fine. But what you get against that is 60 and 70 rupee. What you get against that is 60 and 70 rupee. Green color represents my inflow, red color represents my outflow. This broad theme will continue throughout AFM. My question is, have you earned anything? So obviously yes, when I give 100 and when I get 130, then something I have earned. If I ask you how much have you earned? So is it that you will do 130 minus 100 divided by 100, you say 30% we have earned? No. Because of two reasons. 30 is the total return you have earned over a period of 2 years. First thing. And second, we should have the effect of compounding as well to it, which we ignored. So if we want to find out on a per annum basis, on a compounded basis, how much return have we earned on this investment, then we cannot apply this formula. We have to use another formula called as the internal rate of return. It is a technique which makes us calculate two things. First, a compounded rate of annual return. Could you understand? Before calculating, what are we learning to calculate, boss? We are learning to calculate how much is the rate of return we have earned. And the way to calculate that rate of return is really simple. It is called as internal rate of return. If you want to calculate the rate of return you have earned, the logic is really simple. Sir, you have to actually, the logic is really simple. You have to actually discount these cash flows. One second. Wait. Where is the problem? Why is it not happening? Wait, huh? You have to discount the cash flow of 60 and 70 at a rate, at a rate, at some percentage, right? You have to discount the cash flow of 60 and 70 at some percentage, such that the present value of cash inflow, you have to discount the value such that the present value of cash inflow become equal to the present value of cash outflow of 100 rupee that R you need to find out. What is the rate at which we discount 60 and 70 such that the present value become equal to 100? That is the rate that will be called as IRR. That is the rate that we have actually earned on a compounded basis, on a per annum basis. That is my internal rate of return. Sir, before proceeding ahead to the calculation, I want to particularly ask, could you understand one, what does IRR mean and what is its understanding on the timeline? Like how do you proceed to calculate it? People in the class, please tell me. And not just this, I will also justify it to you. I will also justify it to you on calculator at least. But sir, how can we find out that rate? So whatever we are trying to find out, let's try to create an equation of this, sir. So the equation is really simple. We say The present value of cash outflow 100 should be equal to present value of inflow. So 60 divided by, let's do the present value, 1 plus r to the power 1 plus 70 divided by 1 plus r to the power 2. Sir, in this simple equation we have to find r. Can we simplify it mathematically and find r? My question is, when I say if I have to find out 1 plus 2x is 1 plus x is equal to 90, or 1 plus 2x is equal to 90, you can simply find x. Or 1 plus 2r is equal to 10, you can simply find r. But in this equation, finding r is very difficult because it will be 1 plus r square, so a square plus b square plus 2ab, really complicated. Sir, how do I simplify it mathematically? Sir, whenever you have a complicated equation like this there with you, you have another hack for it, and that hack is called as trial and error method. Sir, try different rates in place of R such that you get 100. For example, let's first of all on our calculator try, for example, say 15%. So 60 divided by 15% is divided by 1.15 equal to m plus. 60 divided by 1.15 m plus. 70 divided by 1.15 equal 2 times equal, because I have to divide it twice, there is a 2 power of 2 m plus, memory recollect is 105. So if I try 15% of r, then what I get as the present value is 105. If I try 15%, the value I get is 105.10. Are you all getting that answer, people in the class? Similarly, if you try 18%, for example, what is the answer? 60 divided by 1.18 equal to m plus, 70 divided by 1.18 equal m plus, memory recollect is 101. So let's try 20%. 60 divided by 1.2 m plus and 70 divided by 1.2 equal m plus, memory recollect is 98.61. So if I assume the r to be 15, the present value become 105. If I assume this r to be 20, then the present value here become 98. So if I want the present value to be 100, then what should the r be? That is the underlying thought, underlying common sense behind trial and error and interpolation method, right? Although the time is 11:05, but if you people allow, can I take the class for the next 5 minutes to explain to you interpolation in the same flow? People in the class, please respond. Are you all there? Are you all there? First of all, are you able to connect to what is going on? And similarly, can I now, people in the class, have next 5 minutes to understand interpolation, trying to teach you interpolation. What we say, please look at this. If, then. If R is 15%, then present value is 105.1. If R is 20%, then present value is 98.61. So if I want the present value of 100, which I already have, then I want to back calculate how much would my RB is the question. And the way to solve interpolation is really simple. I would want to teach you a particular way. If you already know that way, it's really great. However, if you don't know that way, it will be great to learn, because this is the most simple form of interpolation you will learn, applicable to entire AFM, entire CA final, your entire life actually. I will teach you the derivation of interpolation if you already don't know it. What is the derivation? Really simple. The common sense is r minus 15 divided by 20 minus 15. So the derivation actually has a rhythm. We say r minus 15 divided by 20 minus 15. Let me write it down for you. So it is like r minus 15 divided by 20 minus 15 is equal to whatever you have done in the LHS, the same thing you will have to do even in the RHS. What is something you'll have to do in the RHS? It's like the same rhythm. R minus 15 is divided by 20 minus 15. That is equal to 100 minus 105 divided by 98 minus 105. The same rhythm that you have applied in the LHS, you will have to apply to the RHS. Sir, it's like this. It's like this. Perfect. The same rhythm is 100 minus 105.1 divided by 98.61 minus 105.1. That is the underlying derivation formula for interpolation. Some of you might have learnt interpolation in a different way, that this plus this minus this divided by this minus this into this minus this. Sir, this is how you might have learnt, but the underlying derivation for that is this. Yes. My first question to you all, you will have to answer back to back 2-3 questions of mine. Everyone in the class, recorded people, please answer it. Could you people understand the flow or the rhythm to do the interpolation? This minus this divided by this minus this is equal to this minus this divided by this minus this. My first question, super ultra fast, please answer. Yes? Quick. Sir, second question. Did you people also know the same way or some other way? Did you people know this particular way of interpolation? What do you all say? Did you people know it? Quick. Yes, no? If you are using the same way, then the advantage is you'll be able to do it on the calculator at your own. But if you're not using it, then I will have to also teach you how to do it on the calculator. Shruti says no, Harshita says no. Okay, so this is new now, fine. But let me tell you, any possibility, sir, this value from 15 to 20 it increased, but then the present value 105 to 98 it decreased. Any possible combination, positive, negative, anything, this formula will always rock. Always rock. The only thing is that after applying this formula, you should be able to do the maths. Sir, how will you do the maths? Really simple. Sir, 100 minus 105.1. How do you find R? 100 minus 105.1 is 5.1 negative. Do it on the calculator, put it to M plus. I'm also trying to teach you how do you solve it. 100 minus 105.1. Do calculate, answer is negative 105, put it to M plus. Sorted? Now let's talk about the denominator. 98.61 minus 105.1. On my calculator it is negative 6.49. 98.61 minus 105.1 negative on my calculator, right? 98.61 minus 105.1. Yeah, negative 6.49 on my calculator it is. Sir, it is in the denominator. On my screen is a number which is the denominator. The numerator is already there in the m plus. Sir, how do I solve it? Really simple. 6.49 of your denominator, when you press divide equal to, 6.49 is there. When you're pressing divide equal to, you are actually solving 1 divided by 6.49 you have solved. It is 0.015408 something on your calculator that you're doing, that you have done. Since 1 divided by 6.49 got solved, you need to now multiply it with the numerator which is already there in the memory. So multiply with the memory recollect, solves the entire terminology of the right hand side, gives me 0.7858 something. Those who are calculator wise strong would already know how to do it, but otherwise it is my responsibility to make sure I teach you calci also. In AFM, in the initial classes you will find it difficult, but the approach we're gonna have is that solve as much as possible on the calculator only. Directly in the next step you write the final answer. That much capable we will become by maximum in the next 10 lectures is my point. Sir, how do we do it? Again trying to explain, please be super quick. 100 minus 105.1 m plus 98.61 minus 105.1 is equal to 6.49 on my screen negatively. Divide equal to multiplied by the numerator in the memory recollect. So multiplied by memory recollect is 0.7858 something. Whole multiplied by. If I take this number to the right, it gets multiplied. So multiplied by 20 minus 15 is 5, right? So I get 3.929 something. Sir, this 15 I take towards the RHS, I will have to add. So plus 15 gives me a final answer of 18.929. So R is 18.93%. 18.93%. This is how you can solve it directly on the calci. After solving this particular thing, I have multiplied 15 and multiplied 5, and after getting the answer I have added 15. That is how the final answer of 18.93 is, right? We will upgrade this formula of interpolation later when we proceed ahead, but for now is this clear? We will upgrade as we go in the classes further. We will upgrade. For now, people in the class, how much out of 10 are you people? Please settle. Finally respond to me before we call it a day. Second. If there is any doubt, you may please ask. I'm waiting. Third most important, before you go from this lecture, if you have not liked the video yet, please consider liking it only if you like the lecture. Second, give me your feedback, most importantly in the comment section of this video. How was your overall learning? So all the live people sitting here, after we close the live session, please put down your comments in the comment section. How was your overall experience? Did you find the flow, the learning, the way, the things satisfied? How did you find it? Satisfied, sorted, happy, not happy, whatever is your experience. I'm not asking you to put up only the positive, but put up your experience. Genuine one is my point. So Nagendra, Harshita is 10 out of 10. Shruti, Jashwant, could you understand this formula? What do you all say? Settled are we? It means that the conclusion is really important. Sir, if I invest 100 rupee today and if I earn 60 and 70 in every year, the rate of return I have actually earned is 18.93% per annum on a compounded basis is the return I have earned. This is the interpretation of IRR. Since we could not calculate R directly mathematically because this equation is not solvable, we randomly try two number and try to get the present value and then interpolate it. that if r is this, the value is this, r is 20, value is this, but if I want the value to be 100, then how much should the r be? That we back calculate using interpolation. That is what it is. Perfect. So this was all from my side on interpolation. This was actually all on the basics so far for the day, right? The calculator part, Shruti, I'm explaining it again. You can wait, absolutely no problem. Others in the class, Shruti, please wait for a minute. Let me make others clear. Others, I will soon ask the team to create a group specifically for live people. The objective is not to give privilege to you. The objective is to have a daily live communication of joining the lecture. If there's a glitch, I can tell you out there. Anything can happen on that group, right? That group might remain only for a time so long as the live classes is going on. There is another group, the main group, where all the students from all the batches will join, recorded live everyone, where the doubt solving or any other discussion can happen. All these links you will receive from the team in the form of email or something. Okay, you don't have to worry about it. Perfect. One thing. Second, as I said, please, you will have to comment down whatever is your experience after attending the lecture. Yes, experience of the notes, of everything. Third, tomorrow, the next lecture will be on Monday, right? Next lecture and the next lecture when you come up with, please come up with a colored pen. You might find it silly, but you have no idea. When the things are colored, it looks relatively far better. Let me show you a simple example, right? Let me show you a simple example. You see this chart right now? You see this chart, option 1 and option 2. You see this chart now. This is 1, this is 2. This is 1, this is 2. Do you really see a difference, people? So that you have to understand, you cannot be as multicolored as I am through this device, but at least you should have 3 colors with you. 3 to 4 colors, blue, black, red, green, simple 4 colors you should have. It will make your notes really perfect for your last day revision. As I say, you are creating something you are going to refer to the last day, so they really have to be perfect. I will make my best effort to make them perfect. So is also your responsibility. Done? Great. So that was all from my side. If that is all set, Shruti, let me explain to you the formula once again. And others, if you want to leave, you may leave. Thank you so much, all the live people, all the recorded people, for being here, for watching up this lecture. Let's meet back again in the next lecture. Right? Shruti, let us do it. Let us do it. Shruti, do you understand this logic? 1 divided by 5 on the calculator. How do I calculate 5 divided by equal to? So it automatically becomes 0.2. Shruti and everyone else. Similarly, this particular part is 98.61. 98.61 minus 105.1 is 6.49 negative. So if I have to solve 1 divided by, let me ignore the numerator. For right now, let's say I have to only solve the denominator. Can I say 1 divided by this number is something? What is that number? So if I have 6.49 on the calculator, that divide equal to gets solved as 0.15408 something. Could you understand this particular part, Shruti? Please tell me. And everyone else who's watching it. I mean, these are the learnings that should have happened at foundation or max at inter level. Happily, we are there to do it. I'm ready to teach you again, which is why the basic lecture is. Correct? Fine, sir. So now if the denominator is solved, if the denominator is sorted, I need to multiply it with the numerator. So if 1 divided by 5, which is 0.2, is sorted, then 3 divided by 5 will be how much? 0.2 multiplied by 3, right? Because 1 divided by 5 is sorted. So multiplied by 3 is yet to be done now. So if denominator is sorted, You have simplified it, then you need to multiply it to the numerator. So now let me show you the calculation right from the scratch. 100 minus 105.1 you do 2m plus, you put 2m plus, so it's there in the memory. Numerator is sorted. Now denominator is 98.61 minus 105.1 is 6.49 negative. When you press divide equal to, it gets simplified, it gets sorted, it comes to the numerator. In other words, you multiply it with the memory recollect. Multiply with the memory recollect will give me 0.7858. Shruti, could you get it? Right, now I will speak only the calculator step, no explanation. What I'm doing on the calc is 100 minus 105.1 m plus 98.61 minus 105.1 equal to divide equal to into memory recollect equal to 0.7858. This entire part gets sorted as 0.7858. Whole multiplied by 15. So it's a common sense in the LHS, in the denominator something is there, in the RHS it become multiplied. So multiplied by 20 minus 15 is 5, multiplied by 5. Plus this R minus 15 is this particular number out here on the calculator. So if I take it to the RHS, I'll have to do plus 15. So minus in the LHS become plus in the RHS. So plus 15 automatically give me 18.929, which is 18.93. Could I explain it now to you? What do you all say? Come on. Come on, come on, come on. Is it now clear? Okay, you got your mistake. Got it. Perfect. So that's great. That is the objective of me doing it in the class. When you do it, you learn. Else everything is just imagination. Great. So that was all from my side, people. Thank you so much, all the live people, especially for being there with me, making my life also interesting. Recorded people, let's meet back again in the next lecture. Next lecture, half will be basic, half we will start with the actual things that examiner will ask you in the exam. Perfect. So see you all in the next lecture. Bye. Take care. Can we call it a day now? Take care, people. Next lecture, we will quickly revise what we have learned today and then continue the things ahead. Bye. Everyone, see you all. Take care. Thank you so much.